We're going to reveal the opportunity in options trading right before earnings that takes no stock direction risk, takes no earnings risk, and then we're going to review the results with some robustness. We're going to demonstrate the results of this remarkable strategy in the most heavily followed tech stocks. That's the FAANG stocks with Apple, so Facebook, Apple, Amazon, Netflix, and Google. Here's the idea in action. We'll use a 30-day option, and then we'll focus on the 6 days prior to earnings. On that day, we purchase an at-the-money straddle. Then, the day before earnings are released, we sell that same straddle to close the position. We take no stock direction risk, and we take no earnings risk. The goal here is to own this straddle for only 5 days. Now let's start with Apple. We're going to buy a straddle and handle earnings in a custom way. We're going to buy the straddle 6 days before earnings, and we're going to sell the straddle 1 day before earnings, taking no earnings risk and no stock direction risk. And here are the results. We can see a 52.4% return with 7 winning trades and 5 losing trades. But let's remember, the holding period is just 6 days for each earnings release. So that's a 52% return over just 72 days. That's 266% return annualized. Now we'll turn to Amazon. We see a 31.9% return with 9 winning trades. And again, adjusting for the very short holding period, we're looking at 162% return annualized. Now we'll look to Facebook. Facebook is actually a loser. It's a negative 12.8% return with 3 winning trades and 9 losing trades. Let's remember that. Next, we'll move to Google. With Google, we see the best results, a 106% return over 72 trading days for an annualized return of 537% with 9 winning trades and 3 losing trades. Finally, let's quickly go to Netflix. With Netflix, we see a 15.1% return, or annualized 77%, on 5 winning trades and 7 losing trades. So in total, we looked at 5 stocks, 12 earnings periods for each, which is 60 trades. Of those trades, 31 were winners and 29 were losers, for a win rate of 52%, a return of 39%, or annualized nearly 200%. Now let's do some deeper analysis. One quick and dirty robustness check is to remove the best and the worst performer and see if it throws the results completely out of whack. Here we remove Google, the best performer, and Facebook, the worst. We can see the win rate is 53% compared to 52% before, and the return is 33% compared to 39%. So far, our test holds up to robustness, but we have to go further. If you've stuck with it this long, here's the real key. If we turn this into a portfolio, and we did this for all 5 stocks every quarter for 3 years, we would have won 75% of the time. That is, 9 quarters were winning and 3 were losing. And not only did the strategy win 3 times as often as it lost, but the average gain, 6%, was twice as large as the average loss, 3%. We can even go further and look at the portfolio quarter by quarter. We can see that the maximum loss in any one quarter as a portfolio was 4.6%. And there were 5 other winning quarters which were larger than the worst losing quarter. There is a way to trade right before earnings announcements that benefits from the rising implied volatility into earnings, but takes no earnings risk and no stock direction risk. This is exactly how people profit from the option market. It's preparation, not luck. There is no guessing. But the real key here is not the 5 stocks we just discussed. These were the low-hanging fruit. The CML Viz Backtester allows you to discover your own gems. Try the CML Viz Backtester. If you don't love it, we'll give you a refund. Be powerful.